catch up with the program. Sorry. Good. And this series aims to provide you with an introduction to farm finance and what you need to know to get started in a farm business. This series is delivered by Agriculture Victoria through the Smarter Safer Farms initiative. And I'd like to acknowledge the traditional owners of the lands on which we're all meeting here virtually today. I pay my respects to the elders past, present, emerging, and the Aboriginal elders of all the communities who may be here today. So welcome again to everyone who's joining us live and watching us on the recorded version of this webinar. So I'd like to introduce, we've got Pippa Auld here tonight. She is our moderator and will keep us all very engaged by running lots of polls through the session. And we've also got Jane Foster from ORM, who is our technical expert on the farm business risks.
Thanks for that introduction,
Sarah.
Hello to
No
everyone
worries.
online tonight, or hello to everyone who might be watching via a recording.
So we can probably just flick across the slides. Jane?
I've got control of that, so let me sort that for you. That's just
Thank you. Yeah, we'll keep going. So again, this is the third of 5 webinars. So I've still got 2 coming up. Business risks, impact on cash flow, and then putting the plan into actions in May. So there's a couple to look forward to. Again, just some Zoom tips and tricks for those that are listening now. So we can stay on mute and we'd encourage everyone to use the chat function and participate in any polls that we run tonight. So that's probably it about the Zoom tips and tricks. And yeah, so we'll kick off this evening with a bit of a poll on what industry you're from. And this information helps Jane tailor the content for this evening. So if we know what industries you're from, we can help by using sort of more relevant examples. So Pip, if you can get that poll going. And while that's happening, if you can just pop into the chat some of the farm business risks that sort of concern you, or when you think about farm business risks, what are some of the things that you're thinking about on your place? And again, these are the things that will help us, you know, focus tonight's conversation.
Okay, it looks like we've got a few responses coming through, so that's good. That'll help me out tonight. Thanks, everyone. Then I can give you some specific examples of issues or potential risks in your own industries. So I'll keep it quite specific there. I'm jotting down which industries you represent right now.
So what are they, Jane? Because I've got this same problem. I can't see the results. So I'm dying to know where are we from? What's happening?
Okay, so we are 80% of us online tonight from the livestock industry. There's 20% from cropping, and horticulture is also represented. So we've got a nice mix, and I think I do sort of cover a bit of content around those industries already. So that's really good.
Terrific.
Excellent. I'm not sure whether I could have shared the poll share results. Maybe I've got control of that. Can anyone see them?
Yeah, it looks like you can, Jane.
Okay.
Yeah.
So I did hit share there, Pippa. Would everyone be seeing that or not?
Yeah, they should be.
Okay, great.
Cool. And we've got a bit of action started in the chat. So some of those risks that we're thinking of in our farm business, lack of rainfall and grain prices. So I think we've come to the right webinar where we're talking about the right topic. So yeah. Thanks for that input. And so Jane, we can probably
Yep, so I'll just, oh, okay, I just did close off the poll there, so at least we know where we're from. There's a bit of chat in the chat box, which is great. So we're seeing also export markets at the mercy of politics. And Carly said she couldn't see the poll. Sorry, Carly. Yeah, as I said, it was there's a big representation from livestock, cropping and horticulture. So hopefully that covers everyone. Okay, I'll move on now. We might kick into the actual session tonight. So welcome to everyone. This session was to run you through farm business risks. So the idea here is to try and sort of identify what are the main categories of risk that you might experience in your farm businesses. And I'll try and give you a few practical examples and also suggest some of the ways in which those risks can be maybe managed or assessed. So we'll roll through that tonight. I'd love it if you have a specific question, throw it into the chat box and I will try and address that for you. And we'll roll through there. So I'm happy to make this session as interactive as you'd like to with basically any questions you have. And Sarah's just made a note too. We can make these slides available with the recording and happy to share them out to people if they want a copy of those via email. So first up tonight, I thought, well, we talk about risk quite a lot and throw the word risk around, but let's get really down to the basics and the fundamentals. Excuse me. So that was around the definition of risk. So here's a bit of background for you. The word risk is actually derived from the Italian word, which is pronounced risicare, and it actually means in translation to dare. So obviously that means that there is some sort of almost bet laid on a certain outcome, and then that's the daring part, whether we can achieve that outcome or not. Risk does involve opportunity, so it's not always about adverse risk. Sometimes risk can lead to benefits and gains. There's also choice and decision making that's a really important part of managing and assessing risk. The measure of risk really looks at the likelihood that something will occur, and then we also want to assess what would be the consequence if that was to happen. So in saying that, there's two ways of defining risk. We talk sometimes about upside risk. So that'll be that the outcome is actually far more beneficial than we actually had anticipated. Now, we don't spend really much of our time talking about analysing or assessing that risk, because generally speaking, when an outcome is better than we anticipated, we take that gain, we're very happy and we move on. So tonight, I really will focus predominantly when we're talking risk about what we'd refer to as the downside risk. So downside risk is really that assessment of when events happen that will impact us in such a way that the outcomes are more adverse than we had anticipated or predicted. So just keep that in mind. There is upside and downside risk, but tonight I'm really only going to focus on the downside type risks and how we can actually implement some assessment and management of those. Okay, so I think it's just important to remember that, you know, sometimes things do work out better than we expected. And certainly the point of tonight is not to create any sense of panic. We just want to talk about or talk through some of these risks and give you some practical hints and tips. And do keep in mind, as I'm talking about the downside risk, that equally the upside exists, okay? So what are we talking about really in risk? So risk lies in the extremes, not in the averages. So what that means, if we talk something like average rainfall, if we were able to go through a year and it and it did rain and it was exactly this average that we were expecting, then mostly things should work out as we'd anticipated. But of course, the risk there is that it's not an average year. The risk is that it's a much drier than average year. And conversely, in some areas, they also have that risk that it's a much wetter than average year. So remember this too, there's really no right or wrong position in terms of how much risk that you're willing to take on, other than the right risk is what you are prepared to live with. So definitely I see it in my role here. There's quite a variance in the amount of risk that certain individuals or different individuals are willing to take on in their businesses. And some people can live and conduct a business quite happily with quite a high level of risk, and others really don't enjoy doing that, and they really manage their risks at a much lower level. But on the other flip side of that, there really is no reward without risk. It is a necessary part of making returns. It's an absolutely necessary part of operating a business, because basically and this is any type of business, not just a farming business, to be in business does have risk involved with it. So in some ways, by going into business, you're already accepting that there are going to be risks that you'll be exposed to. But it's about now managing them that aligns with, I guess, your own acceptance of how much risk you want to take on. And then also your decision making. We can really only make decisions based on the information we know today and our best estimates of what might happen in the future. So sometimes, as I said, things work out better than we expected. But funnily, humans are not always programmed to experience the upside risk the same as the downside risk. We tend to have a really strong aversion to regret, and regret tends to be aligned to those downside risks. So it might sometimes feel like we have a lot of downside risk in our life because we are more programmed to take notice of those risks rather than the, say, the upside risk where things work out better than we expected. We tend to accept those, move on, and not dwell on them too much. So I think that's an important thing for everyone to understand, partly about themselves as well, that you'll all have your own individual feelings about how much risk you want to take within your business operations. And that's fine. It's just about what it is for you individually and how you can best manage your business to align with those risks that you want to take. Okay. So a risk matrix that's used in a lot of business applications, and particularly I've seen this used a lot in really sort of large businesses, is a risk matrix. So the risk matrix essentially works that you can categorize what the risk level is. And so it's really taking a view of the likelihood of whether it's a highly likely risk event, or a low likelihood. And then you work through what would be the severity of the impact of that risk. So if we look at the bottom left-hand corner of that box, we'll see that if it's a low likelihood and low severity, we probably don't spend too much time. We accept that and we move on. As we move into that midsection, where we're moving up, more likelihood, more severity if it does happen, then we start to get into some assessment of whether we'll allow it. So we will take it on. Then as it becomes a slightly more severe risk with a higher likelihood, we might put some plans in place around what we would do if it actually eventuated, or whether there is some sort of strategy we can take within our business to in part mitigate that risk. So we can either try and mitigate the likelihood of it occurring, and if we can't mitigate the likelihood, then we might look at how do we mitigate against the severity of impact. So sometimes we can take actions that reduce the likelihood, and then in other situations, all we can really manage is the severity of the impact to our business. And then as you get to that top right-hand corner of the assessment, so we're saying it's a pretty high likelihood, or it is a high likelihood that it's going to occur, and the severity would be quite extreme. It would have a quite severe impact on us. We want to try and avoid those risks. And so it's kind of in that middle section where people will vary in their approach to how they manage and assess their risks. So as we move through tonight, the way that we're going to work through this is we're going to look at the risks in some distinct categories that you would see them occurring in your own businesses. So we're going to look at production risk firstly. I will then move through into market risks. And so for Carly, we'll be looking at, in terms of production risks, you mentioned that one of the risks you're concerned about is that lack of rainfall. So that'll be covered in production risks. And then we look at market risks. And so that's going to cover things like grain prices. So we're going to hit the mark there. And also I can chat about export markets. And then we'll move through into the financial risks. And I'll talk about key person risk. So that would be something maybe that's not as widely spoken about as the first three. And then we'll move on and finish up with some compliance risk, and I'll give you some further resources on helping you out with some of those compliance areas. So moving through, let's start off. Production risks. So in agriculture, this is probably one that gets quite a lot of attention. So for production in livestock, obviously we're looking there at, being able to produce the right numbers of livestock as output. In cropping, we're focusing on our yields and being as productive as possible. And in horticulture, in the same way, we're looking at yields. So a big driver of some of our production risks are the following things. So climate. That's a big one. It's about that reliability of rainfall. So are we expecting a wetter than average year, a drier than average year? What's going to be happening in that next cycle or period of production? And in some aspects, for example, cropping, it might not just be the reliability in a sense of what happens over the year, but it can also be the timing of when rainfall events occur. And secondly to that, if you got an average year, but the rainfall happened in one single month, well, that would not be ideal either. So it is a matter of a couple of functions. It's the amount we get over a 12-month period, and it can also be the timing and how much rain we get in one event. There's also clearly pests and disease. So this is one, for example, where we can maybe have an impact on the likelihood that these things occur, whereas obviously with climate, we have very little ability to influence the likelihood of whether we get an average, above average or below average year. So with pests and diseases, that's your fungal bacterial type issues, and really anything classed as a pathogen. So your pathogens are your fungal vectors, your bacterias, viruses, for example. But also I've included their predators because that can be quite significant. For example, in a sheep enterprise with lambs, there can be quite significant losses of lambs to predators. I'm also going to cover or identify that there are physiological issues that can occur. So that's environmental stresses, and that's particularly important across livestock enterprises because those physiological stresses will definitely have an impact on, for example, weight gain in animals. So they're important as to, how quickly we might be able to get animals up to market specs to sell. And then secondly, when I say climate, and I was talking really about the rainfall and the timing, and then I thought I'd also highlight out specific weather events can occur because we might have had a great year, pretty average rainfall, it occurred at around the right times that we wanted it, but then we got a cracking frost at just the wrong time. So that's obviously really critical in, say, a cropping enterprise. They're quite susceptible to those types of events. Also, horticulture can be susceptible, or you might have a hail event. That's also something that is a weather event that can be quite a risk across a number of agricultural enterprises. Look, I did include cyclones, probably not so much in Victoria, but I thought, like, let's, talk broadly and identify that that does impact. If any of you ever travel further north, you might find yourselves in a geographic area that is a consideration. And then things like floods, clearly, like, as I said, that's about, if the rainfall occurs, but it occurs all in 3 days, then flooding issues might be something that you're contending with as well. Okay, so moving on. So, for example, just to really draw out what this risk looks like in terms of the climate events, so that to me is, we tend to really focus a lot on rainfall, and that's because a lot of the agricultural production is really, it's a foundation of what we can do or what we can produce in any given 12-month cycle. This is from a climate tool called Forecasts for Profit, and it's just available on the web, so you can actually have a look at this yourself. Basically, anywhere there's a weather station, you can click, there's a map of Australia on the tool, you click into whichever weather station would be closest to you, and it will have this type of data. And so what I've put up on the screen for you to look at there is you can see how variable annual rainfall can be. And so that is a distinct and appreciable risk in businesses. It also shows you that really what happens in one year is not necessarily a predictor of the next year. We can see that there's quite a variance. You often have a very dry year, can be followed by a very wet year, vice versa. We can get a run of closer to average years. So for Swan Hill, since 1900, with all the rainfall data that they have there, the average rainfall probably looks to be around the 330 to 340 millimetre per year mark. What this also shows is the colour of each of the bands describes whether that year was a La Nina, an El Nino, whether there was a negative IOD. And so just to describe that, the La Nina and El Nino events, they're designated by conditions in the Pacific Ocean, and the negative IOD refers to the Indian Ocean dipole. So what that's looking at is ocean conditions, and those ocean conditions basically designate to weather forecasters whether it's a neutral year, a La Nina, an El Nino, and then you can get combinations of El Nino and positive IOD, or La Nina and negative IODs. So you probably already know, but a La Nina tends to indicate a drier than average year. A wetter than average year, and an El Nino is a drier than average year. And similarly, if you get a negative IOD, tends to indicate a wetter than average year, but a positive IOD will tend to tell us that it's going to be perhaps a drier than average year. So the double combination perhaps of an El Nino and a positive IOD would be predicting a very much drier than average year. And you'll see that that's the red bands. And generally across each of those red band events, you'll see that the rainfall is lower than average. However, it's not always the case. And so that's where the risk is very hard to predict in terms of these weather events. And I know that across agriculture, there is a lot of time and effort spent trying to predict what seasonal conditions will look like. So in every business that's based fairly well on agricultural production that relies on rainfall, this is definitely one of the more significant risk factors that are experienced. I might just move us across to the next slide. This is basically, again, showing the annual rainfall, and I've selected Swan Hill as the designation on this one. And what it is showing is in each year, if 330 is our baseline, the red bars down indicate that we got that much less rain than the average, and the blue bars represent that we got that much more rain than the average. So looking across that, you'll see that the average probably doesn't really tell us a lot about what's going to happen year to year. And that's where at the start we said that risk is in the variation. So it's the more extreme events, those much drier than average years and those much wetter than average years. And that's what we have to try and manage around and for. So, for example, in a livestock enterprise, the drier than average years will have significant impact on how much pasture is available. And so that would mean that we might have to rely more heavily on fodder. And so to mitigate against those drier years, one of the key, I suppose, recommendations is either to have some sort of cash reserves that can be used to buy in fodder, or else I know there is a lot of work around providing, there are a few government grants around to enable people, farming operations, to build sheds that would enable them to store more fodder. And so you can address it in one of two ways. Either you have cash reserves that you can use to buy in the fodder when it's required, or you store the fodder yourself. And obviously then when you hit those drier years, you can utilise it. Now, one of the other things is obviously if it's a drier than average year and everyone's experiencing that same thing, sometimes fodder can be significantly more expensive. And so that's why the storage options are certainly being encouraged, because then what you can do is when there is supply in the market, you buy the fodder in. If you can't produce it yourself, you can store it, and then you've got it available to use in those drier years. And obviously with livestock, it's incredibly important to be able to sustain them through any period where the pastures or your own I suppose pasture growth or fodder reserves would be sort of used in the normal course. So when you hit those dry years, you're going to have more reserves to draw on. Okay, so that's a bit of the Swan Hill example, which I drew out. I also pulled up some data for Lake Bolac, which is more in the southern part of Victoria. So you'll see here that the rainfall averages closer to around that 530 millimetre mark. So we're already starting in that area with, on average 200 millimetres more rainfall than Swan Hill would expect. And so that would mean that in terms of their business risk, they aren't necessarily less, because in Lake Bolac, they might set up their farming system that relies on that 530 millimetres of rainfall. So in that situation, you still need to make some assessment of how much rainfall that you really are relying on in your system. And then you need to sort of factor in around that when you do get the drier years. And so in this example, again, the individual weather conditions prevailing at the time are highlighted. So you can see the red bars again, that's when there was an El Nino and a positive IOD present. But if you look across generally through since 1900, the red bars there certainly look to have all been above at least 300 millimetres of rain. So that should give a bit of an indication that this risk is also quite variable depending on which geographic region that you find yourself in. And so it's really important that you have a farming system or production system that is matched to the prevailing conditions that you're farming in. So for example, in the livestock type enterprise, that might inform what your stocking rates are. And in cropping, it'll obviously have some direct translation on what you can budget to be your, average or expected yields. And in horticulture, as we get into the north, there's quite a heavy reliance on irrigation, so that those trees can be sustained through summer periods and still produce good yielding fruit. But then, of course, there's a cost involved with irrigation, so that has to be factored in as well. So again, the next slide just shows us the variance of rainfall in any given year from that average. And as you'll see again, a lot of years where there is variance, not too many where we're really close to that average number. And so that's a big part of what needs to be managed in farm production systems around rainfall. And then as we get into, say, a livestock enterprise, if we get the average rainfall, we'd expect or hope that, our pasture production can be achieved that meets our needs. But in a cropping situation, it's also a matter of when the timing of the rainfall. So I know that in some years with cropping, we've had quite dry winters, but then there was rainfall at the required times when the crops really shot into their sort of seed set stage. So rainfall is always going to be something that is managed for and around, and we really tend to focus probably a lot more time on how we manage those below average years. But I know, for instance, in an area of Lake Bolac, there is a bit of cropping that goes on. And in all honesty, they have to give strong consideration to the above average years, because they're already sitting on around that sort of 530 millimetres of rain in an average year. At around that sort of 750 millimetres of rain, they can get significant waterlogging happening, and that also impacts their production. Okay, so let's move on, and I'll give you a couple of just practical examples. So again, if you've joined us for the last 2 sessions, you'll remember this slide. It's just to reinforce to us what sort of production systems we are talking about when we are talking farming. So I'll go through a couple. I've probably touched on them. In cropping, the amount and timing of rainfall is particularly a production risk, and pathogens are also another production risk. So there is a lot of work going into things like resistant crops through different variants. So things like red stripe rust and anything that's really going to have an impact on that yield. In horticulture, again, pathogens, can be quite a significant issue. And then also hail and frosts, and obviously frosts in cropping as well. Beef cattle, so we're looking there at sort of the annual rainfall, more specifically, what sort of conditions we've had around pasture production, what calving rates we've been able to achieve. And sort of calving obviously flows on from the conception rates, and it's really important there that we try and minimise those physiological stresses to ensure good conception rates. In dairy, health of the herd can be really important. Animals that are unwell or sickly, milk production will be immediately impacted. Also, again, conception and calving rates, so the ability to bring a cow back through for another lactation cycle. And weather, temperature can be really important in terms of unseasonal heat waves and things like that. Very hot weather can affect milk production, so all of those issues. Again, with, say, wool production, nutritional changes and seasonal conditions can impact. So wool's probably one of the more resilient type of commodities that we produce, but things like fly strike do cost the industry quite several millions of dollars, and fly strike tends to be more prevalent in some seasons than others. In terms of sheep production lambs, so again, seasonal conditions, getting those better conception rates, higher rates of twins, for example. And also I've nominated their predators. So there is quite a big focus on trying to eliminate or mitigate issues with predators, especially at lambing time. So that can be predators, wild dogs, foxes, also birds of prey can be an issue there. So when I say predators, you're obviously trying to reduce your likelihood that your lambs will come under predator attack. So people do obviously take initiatives to try and reduce down the numbers of predators, particularly with, say, foxes. And so that's one where you're trying to reduce the likelihood, because obviously the outcome is pretty dire in terms of you will lose lambs to predators if you have a fairly high instance of predatory animals. And then I thought I'd include a couple of intensive systems as well. So poultry, particularly for meat. So really hygiene can be a critical one there, because that can certainly impact quite quickly on the health of birds, and it can also give rise to perfect conditions for high pathogen loads. So that might be viral or bacterial type issues. And again, pigs, meat production, piggeries, hygiene's a huge factor there. It is a significant risk in those intensive systems where animals are very closely housed and in a high intensity, because essentially illness in one animal can be transmitted very rapidly across a very significant number of animals, and that will flow on to certainly production issues where worst case scenario, there's significant losses of animals. Okay, so hopefully I've touched on a few there that you all have been thinking about. I think we're going to run a production risk poll now. So I'm not sure, Pippa, are you coordinating that one for us?
Yes, it should be popping up just now.
Great. It's popped up on my screen there. Pippa, can you see the progress of the poll on your screen as well? Oh, I think I can't hear you, Pippa.
All right, yes, I can see it.
Oh, okay, great.
We've got some votes coming through now, so
Yeah,
if people can pop their votes in, that would be good.
Yeah, so we just give everyone a few more seconds to vote and see what our results look like at the end of all of that. Don't forget to shoot me a note in the chat if you have a specific question that you want me to try and answer, and if I can't answer it straight off, I'll take it on notice and try and come back to you. So, okay, it looks like we've got quite a few results through. Pippa, are you able to share those with the group?
Yes, there we go. People should be able to see those now.
Yeah, I can see the results. So basically the question everyone was asked was, which of the following production risks would you spend the most amount of time managing? So we had 20% on climate, 60% of responses were around pests and diseases. So yep, that's certainly an interesting one. Not so much on the physiological components, but also then, yeah, weather events did get a vote there. So 20% of us spend time thinking about weather events. So I think that's, yeah, fairly indicative probably of the range of enterprises that are represented online tonight, because certainly some of those are stronger considerations in certain enterprises than others. So for livestock, I would say, yeah, pests and diseases would probably be one that does get quite a lot of focus, as opposed to maybe weather events. because animals tend to sustain themselves quite well through weather events, other than flooding is one that obviously they do struggle with. Okay, so hopefully everybody was able to see that, and we might move on now. Okay, so the next segment we're going to talk about is commodity risk. And I know we do seem to be progressing probably not so quickly through these, but I'd say the first three we're going to spend quite a bit of time on tonight, and then key person and compliance will be slightly shorter sessions. So we will, don't worry, we will have you all wrapped up within our time together tonight. Right, so commodity risk, market risk. So what are we talking about when we refer to this? Okay, let's have a look at an example. So here I'm showing you the market price for wool. Now this is taken from Trading Economics, and you can get a lot of this information online on websites. It's very freely available. So any type of agricultural commodity websites will often give you this type of information. So what we're looking at here is, and this should be 20 micron wool that we're looking at. So you can see there we've got some data starting at about 2011 right through to the current situation. So through 2012 to 2014, the wool price, and that, sorry, should say it's 1,000 cents per kilo, I believe. I'll have to check that. So the main thing, I suppose, here is not to be too focused on the axis, but look at the variation in price that can occur within relatively short time frames. So between, say, 2014 to 2016, we saw a really quick spike in price, and then it fell away. And then from 2016 right through to about 2019, there was a really sustained trend with upward price of wool. And so this is where in our production systems, we can produce an amount of a commodity, and then we've got to go out and sell that in the relevant markets. So obviously the greater price we can achieve for that quantity that we've produced, the better the financial returns will be. So coming through that post-2018 period, wool was very lucrative as a commodity. And certainly when we were doing budgets for clients, they had a mixed enterprise. They certainly had a significant financial contribution coming into their cash flow from their wool clip. Now, if we look at what happened, in effect, there was a quite sudden and significant drop in price around 2019, but then it did rally back to sort of the previous levels that we'd experienced. But from there, 2019 onwards, the price of wool just continued to drop to the point where post 2020, it fell to levels that were below any price we'd seen in that prior 10-year period. And so what I can really say from that graph and explain is that a significant part of that very sudden price drop had to do with the prevalence of COVID-19. It just basically impacted all of the end products that wool was utilised in. And so the building price through 16 to 2018 probably reflected the demand for wool on a global scale. So a lot of products that wool was going into were highly sought, but COVID-19 really disrupted that type of consumer demand, and that then had to flow through to the price for the raw commodity. It has started to rise slowly back to sort of levels that we saw around that 2016. But I know, for example, when we were doing clients' budgets in 2019, say at the start of 2019, they certainly were expecting fairly significant financial inflows from their wool to continue. And at the start of 2020, we still had that budgeted at a level. And then from therein, we had to go back and significantly revise how much they expected to receive for their wool clip. And so that had an impact on their financial performance for the year. The other alternative was, luckily, wool's quite like it's able to be stored, and it can be stored for a length of time without much adverse consequence. So the other option was they just held the actual wool clip and weren't able to sell it out. So that's where commodity markets can have a really sudden and significant impact at a fairly in a short space of time. And so with commodity markets, there's a few ways to manage around that. So one was obviously some people took the option of storing. If they're able to do that because they had the financial resources that they weren't relying on the income, then they did certainly do that and choose to try and wait the market out so that it would correct. Sometimes too, you can actually take forward sell contracts. So that would mean trying to lock in a price ahead of time so that at least as you're planning through your next production cycle, you have a reasonable estimate of what you might expect to receive. And wool is one area where generally your production levels don't fluctuate like very significantly. So as long as you can keep the animal's nutrition at a fairly stable level, then you'll be able to produce your wool clip. Whereas cropping forward contracts tend to be a little bit more problematic because you never quite know how much production you might finish the year with. Okay, so basically with market risk, we look at the volatility of the price and how quickly it changes. And we also want to have a little bit of an understanding of why that might happen. So with wool, for example, any change in demand for products that wool is a component of will definitely have an impact on the price because generally the supply of wool in global markets remains fairly stable. There was obviously too an issue when there was drought, fairly sustained drought up in New South Wales and southern Queensland. A lot of those properties that did run sheep had to reduce numbers, and those numbers basically left the national flock. So if we looked at the numbers of sheep across Australia, they reduced, and that meant that the wool clip available for sale out of Australia had reduced in size, and that helped push those prices higher through 16 to say 19 because there was just less volume of wool available. But then what happened is post that period of time when COVID struck, it really hit the demand side with consumers not buying as much. A lot of supply chains became very disrupted. So businesses that used wool in production to produce an end good, a lot of them actually with COVID had significant trouble producing the same volumes that they did. So obviously their demand for wool was lower. So all of those factors influence that commodity market risk. So we should have a bit of an understanding about how that looks for, you know, the commodities that we do trade. Now, I am going to show you another slide, and this is again around wool, but it represents the price in a very different way. So in regards to this one, it's showing you a cents per kilogram. And the line down the middle shows that, say for 20 micron wool, the mean price or the average price is 1,932 cents a kilo. But have a look at the bars in that graph. What they're showing you is the frequency of each of the prices. So it's saying that of all of the price data that was collected over a period of time, which in this instance is January 2017 to December 2019. So for about 4.5% of prices were at that low end of 1486. And similarly, about 3.5% of the prices were above or around that 2,400 mark. So you can see there's quite a wide and varied distribution of where those prices were. The most frequent price really in that whole data set at about 13.5% of the time was 22.30, so 2,230 cents a kilo. Now this does take in 1st of January to December. So this was that period of time when prices were steadily increasing that we saw in the prior graph. So what that tells me is really when I'm, I suppose, budgeting or looking at my price that I can expect to receive for the wool, I might use a price, an average price, but the reality is my chance of the price actually being at that average is probably fairly low. And in this case, the mean price of 1932, we probably only saw that around 6% of the time. So you can see there that that's the variation. Now, obviously, if we went to market to sell and we were working on an average at 1932, if we actually received, say, 2,300, well, we wouldn't be too fazed by that. We'd just take that benefit and move on. But what we would be trying to really put a bit more thought into is what if we come to market and the price is at more like 1,600? That's quite a bit less than we anticipated. And so that's where sometimes we might take those forward contracts, or we might store and we might wait for the price to hit a mark that we actually are more comfortable to accept. Okay, so this graph here is quite a different one because it's looking at each price band and analysing how the frequency of how often we were at that price over that period of January to December. So I know it's a touch confusing, but hopefully you followed me through there, and it's really around making you aware, I guess, of that variation. And as we said at the start, the risk is in the extremes and in the variation that we can expect to see. So moving on, I have another example, and this time I've looked at adult sheep. It's quite a different type of pattern in the graph. So we can see here that the mean is at 450, and that's cents per kilogram. But our actually most frequent price that we saw was between 414 and 432. And we saw that the price was between that range about 31% of the time between this one's looking at April 2018 to November 2019. But we also see that it has more of a pattern to it, where it's more of what we call a normal distribution, although it does have a bit of a skew out to that higher end. So again, some of those higher prices might have been driven around supply at the time. So once in the north, most of the properties had destocked, there wasn't as much supply coming to market because once obviously the properties had gone through that destocking phase, they weren't in the annual cycle of production any longer. And so again, looking at the price, the difference between, say, selling livestock or, for example, wool, is I might just quickly go back. We can see here a really scattering of prices. That's because really with wool, you can be far more discerning as to when you decide to sell. You shear the sheep, wool goes into storage. There's nothing really detrimental that's going to happen to it if you don't sell it today, you don't sell it in 6 months, you could sell it in a year. The wool bales will still be there. The wool quality will not have deteriorated. Well, that's not really true of an animal production system. There's often some very prescriptive timings around when you will need to sell animals out. So, for example, particularly with adult sheep, you might be culling out weight for age ewes. You really need to cull them out of your flock at a prescribed time so that you don't take them through another annual cycle and have to basically sustain them, provide nutrition, and they may not be as productive as younger animals. And so then in that instance, you really aren't able to just hold and wait for the market to return. And so that's why then you'll see more frequently over that period. There was a set, the price was between that 414 and 432. There was some prices out above that 550, but it's very difficult with livestock if they're ready for market, or if that's the timing that suits your production system. It's very hard to just sit and wait for the market to come back to a level that you're happy or comfortable with. Moving on from there, I've also shown you a couple of examples in this of commodity prices. The blue line is wheat, the green is lupins, the pink is lentils. Even individual grain categories have their own dynamics because, for example, wheat is a very big and broad commodity. So lots of people buy it, lots of people use it, lots of it's produced. And so there's quite a big, strong global market. Now, we did see wheat prices really push up in that back half of 2018. And again, that was a lot to do with the drought in the north. They weren't producing grain. They hadn't produced grain for a couple of years at that stage. And so essentially, the domestic grain supply was extremely tight and people had to pay higher prices to be able to buy grain. Once that drought in the northern areas broke, you'll see that blue line starts to really drop away around February 19, April 19. It comes back down. That you're looking at that blue line, and the blue line is the price per tonne on the left of the graph. So it was coming back around to $300 a tonne. Whereas the grain, say lentils, the pink, lentils have a much different market to wheat. It tends to fluctuate more quickly, shows more volatility because there's not such a broad and deep market for lentils. And so in terms of each of your commodities, it's important to understand those sort of market attributes that they have. And so I know a lot of grain producers, if they produce lentils, they know that they need to be in a position where they might have to store the lentils, for 1 or 2 years. And so they need to make sure that they have the capacity to store lentils for that period of time, because the market can drop away quite quickly, and then they might have to hold for quite a length of time before they are prepared to actually transact a sale. So if we look back to September 19, we could see lentil prices at about $450 a tonne. And now lentils are quite expensive to produce. And then if we look to more recently, January 20, it's jumped up significantly, and it's above $650 a tonne. So just in that sort of period from September 19 to Jan 20, it went up significantly. So of course that would mean it's quite worthwhile to store in that instance. And really around grain, one of the key, I suppose, risk strategies that more and more people are actually employing in their businesses is their ability to store the grain so they can actually ride out some of those low price periods. Okay, so that's a bit of a story about grain. So whilst our different commodities themselves across livestock, crops can be different, individual crops such as wheat, lentils or lupins can also have very different market dynamics and risk, commodity price risk. Okay. Again, this is the same frequency graph shown that I had for wool and sheep. An interesting part of this dynamic is that essentially we can see that the average was around 300 for this actual set of data. But basically, once we get down to a price of about 204, there's no lower prices that we saw over this period. Now, that tends to be a bit of a dynamic applicable, particularly to grains. We see it a fair bit because at around that $204 mark or $200 a tonne, it would start to become questionable whether you were actually making money to produce that grain. And so what happens is if people are holding it, they just don't sell it below that price and they continue to hold it. And so that's why essentially there's a bit of an endpoint on basically how low the price of grain did go over that period of time. Whereas you'll see as we move out to the right-hand side, it just gradually sort of steps down. And that's because obviously everyone's very happy to take the higher prices and they're very happy to take as high a price as they possibly can. Again, with grains and pulses, similar graph. This is for lupins. But it just again shows you the variation in distribution of prices, so I won't dwell on it too much. Okay, and now we've come to the point we've got a quick commodity market risk poll. So again, shoot me through any questions in the chat that you've had while you've been listening. The question that we're asking at the moment is, do you lock in your product with a buyer? So we're just trying to gauge there, is everyone online selling in open markets where they have to take the market price, or does anyone there have sort of fixed arrangements with buyers where they have a contract price that they are able to sell at? So we'll leave that open for you all for a few minutes, get some responses and see how we go. I'm going to have a sip of water while you're doing that.
Take a breath, Jane. You've been churning through a lot of material there.
Yes, I have, and I'm looking at the time and think I have to churn through a bit more before we end tonight's session. So, okay. So we do have some results there, and I can see them on my screen. Hopefully everyone can.
I've just shared them now.
Great. So yes, 17% or one person responded that yes, they do have some contracts or locked in prices. 5 people there saying no. And that's probably, it doesn't surprise me, that's quite indicative of the industry as a whole. We tend to be more subjected to market prices. And thanks, Carly, I can see you in the chat box said you actually do both. So there you go. We didn't have that as an option, sorry. Now we're going to move into financial risks, and I'm going to roll through these quite quickly for you. I'll move that out of the way. So I'm going to cover interest rates, quickly work through some foreign exchange, talk about working capital, talk about operating losses, and I'll wrap up there a bit on creditor default. Okay, so interest rates. This one's fairly topical, particularly if you have some debt in your business. So if you've borrowed money from a bank, obviously at some point in time, they might want you to repay the actual principal. But while before you do that, each year, each month, they're going to charge you some interest on the amount of money that you owe them. You'll see this is just a bit of a historical representation of the cash rate, and the cash rate does tend to inform the rate that you will pay on your debt. So as the cash rate comes down, so too does the interest that the bank tends to charge us. So you'll see that there was a big drop from about 1990 onwards, and that was the recession of the 1990s, because this is a young farmer session. Possibly many of you don't recall that, but it was quite a significant recession in Australia's history. 2010, we see a really sudden and sharp drop. That was the global financial crisis. So these are instances where, for example, we didn't really see that global financial crisis coming, and it was quite a shock to everyone. But the result was that rates, the cash rate, which was nearly at 8%, dropped suddenly and significantly back down to about 3%. And then more recently, we'll see it right at the end of that graph, it tails right away. That's as a result of COVID-19. So the Reserve Bank took measures to reduce interest rates to try and keep the economy stimulated. Now, why this is a risk in your business? Because if you do have debt, then interest rates will have a very direct impact on your cost of borrowing. And your interest is an expense in your business. So as rates increase, if you have significant debt levels, you need to be able to manage that aspect. So one way is to look, you can always do a bit of, we call it a sensitivity analysis. So even if you're paying, say, 4% today, do a quick calculation on what you might have to pay for interest if interest rates were 6%, and just look at your business structure and see if you can actually afford that. One of the things that you might look at implementing if you couldn't afford an increase in interest rates is the banks can offer you fixed rate options. So they're often from 1 to 5 years. The only thing being you have to have a look at what those current rates they're quoting are, because generally it's not the same as the variable rate. Okay, so that's interest rates. We also in agriculture are exposed to exchange rates. Now, this tracks the exchange between the Aussie dollar and the US dollar from April 2016 right through to current April 2020. So fairly well, it tracked around and it bounced around above about 69 cents, and it didn't go higher than, say, 80 cents right through from April 2016. But have a look what happened just after February 2020. Direct impact again, COVID. We didn't really understand probably in February 2020 what that was really going to mean for us. But what happened was that once that did happen, our Aussie dollar dropped suddenly and sharply against the US dollar. Now that actually is quite positive for agricultural production, because it makes our exports a bit cheaper to to countries that we're exporting to. We still receive the same Australian dollars. They don't have to pay as many US dollars, makes our product look cheaper by comparison to other parts of the world that they possibly could source the product from. So they'll consume more of our product versus other products from other countries. But then we see from about Feb 2020, or it's probably more like April 2020 onwards, the dollar continued to rise, and it's actually come back to around that sort of 75-cent mark. And that represents a fairly strong Australian dollar, and it does make our exports slightly more expensive, which will have some impact on the demand for those on the global platform. Okay. Now, if you were directly involved in exporting, then exchange rates would have a really significant impact on your business, and you probably take a more active role in managing them. But in terms of if you're not directly involved in exporting, it does influence the demand for our products on that global stage. Next, we'll talk about working capital, and if you've joined us for the last few sessions, this won't be the first time you've heard me speak on it. So working capital is really the the assets that you have in your business, like cash or accounts receivable. Accounts receivable is really just money that people owe us. So if we've supplied grain to them on terms, so we've allowed them 30 days to pay, then that'll be in our accounts receivable. And then we might have inventory on hand. So if we've stored some grain, we've got it there in inventory, we can sell it out quite quickly. So these are all the things that are either cash or could quickly be converted into cash. On the flip side, current liabilities, they're the things, amounts of money that we owe to people. So they're the payments we're going to have to make over the next sort of short time in business. And so we always need to make sure we have enough cash or things that we can convert into cash quite quickly to be able to pay those bills going forward. Okay, so that's working capital, and that's where budgeting and cash flows can be an important part of managing this working capital aspect of our business, because the cash flow will tell us if we're going to really look like we might run out of enough working capital over any period of time throughout the year, and then we can make the relative adjustments. Banks are very big on understanding whether you have enough working capital to get through a year, particularly in agriculture, where we deal a lot with annual type production cycles. It's probably not quite as much of a focus if you're in, say, dairy, where you tend to have sort of that monthly income stream while throughout that lactation period. Many businesses have encountered some significant problems because they just haven't adequately planned for their working capital. So just think of this as being that I have enough cash or assets that will quickly be able to become cash to pay the bills that I need to. So that might be feed, fodder, supplies, chemical, those types of expenses. And then operating losses. So if we do get through a full year, and there was some adverse events that impacted us, and perhaps our income did drop significantly because seasonal conditions were not really favourable. So that might affect our income. Say if we were able to generate $450,000. Meanwhile, it still cost us a similar amount to run the business. So maybe this is particularly if I look at, say, a dairy scenario. If that milk price is dropped substantially, it's not really feasible to really quickly cut costs in a dairy business. It usually involves having to destock, and that's obviously a really last resort, because then once things return to normal, you've got to try and build those numbers up again. But if that were to happen, and we knew that throughout this next year that was a problem, our expenses might be $600,000. So we get through that period of time, and we've actually used up or made a loss of $150,000. So that's cash that is just not there next year to be able to, pay for our expenses to help us manage through. So we've really used up $150,000 of available resource just to be able to meet our expenses of this year, because our income wasn't high enough. And so that is a significant financial risk. And the main one there is to probably take a long-term view. And this is why banks tend to be really focused on equity, which I know gets frustrating for a lot of people, because banks often will say there's not enough equity here to lend this money. But the reason that they focus on equity is because equity is what will get you through a period of time where you might find that your income was significantly impacted, but you still had to spend money throughout the year, and at the end of the day, you made a loss. If you have equity, that you can draw on that equity through taking on maybe some additional bank loans to help you get through the next 12 months. And hopefully at the end of that period, you've returned a profit, and that will then help you keep rolling through in business. So yeah, operating losses can be quite problematic if we don't have a way to be able to basically have enough cash available throughout the next year to run our business. And this one is creditor default. So I did want to touch on this one quite quickly. So sometimes in a farming enterprise, we sell commodities or our production to a third party. They don't pay us cash right at the time that we sell. They might pay us cash they might have 30 or 60 days to pay. We talk about the counterparty risk, if you've heard that term. So why this is important, because for example, here, if we're owed these amounts of money from certain people that we've sold one of our commodities to, we obviously have a significant exposure there to Grain Guys. What would happen if Grain Guys went into liquidation? And that means basically that Grain Guys business has been unable to continue to operate. So they have either run out of working capital or they had sustained operating losses and they couldn't continue on. So they might appoint a person called a liquidator, and a liquidator basically comes in to see what's left and then pays money out to whoever's owed money by that business from whatever there is available to them at the time. But sometimes it's the situation the liquidator might say they can only pay 10 cents in the dollar. So that means for every dollar that was actually owed to you from Grain Guys, you'll actually only receive 10 cents. So instead of the 130,000 you're expecting, you only get 13,000. Now, one of the things that you would want to do here is you want to reduce the likelihood that this occurs. So how do you do that? You might manage the amount that you let any one person owe you at any time. You might not give credit terms to anyone that you don't know. So you might actually wait until you have a track record of dealing with them. So I know a lot of our clients, if it's someone new that they've never dealt with before, they actually will not supply unless they have payment before the truck leaves. And that's particularly with grain and hay. Very hard to ever retrieve your grain or hay once it's left the property. So that's definitely, I suppose, don't feel under pressure to provide credit terms to people you don't know, because sometimes it might be better to sell to someone else, miss that sale. Ultimately, if there is a risk that you won't receive the money they owe you in the long run. And secondly to that, you can just make sure that no one person owes you a substantial amount. So in this circumstance, maybe you thought, well, Grain Guys, you know, we won't have them owe us 130,000. We'll only let that be 30,000. So you can put sort of credit limits on people, and in that way, then obviously if they went into liquidation, you can't really affect the likelihood too much that might happen, but the consequence is certainly a lot less to your business if they only owed you 30,000. So that's creditor default. And some of the flags when you're dealing with creditors, if they need really long payment terms, so if they're asking you for 90-day terms, so you supply to them and they don't pay you for 90 days, that could be a flag that they have some cash flow problems. If they're offering you a really premium price that's considerably above the market, that might be also a red flag, because it might demonstrate that they're having to do that to be able to get supply, because a lot of people won't actually deal with them. And also if they won't sort of enter into any, in grain, there's a lot of supply contracts. If they won't enter into any contracts or they have strange terms in their contracts, that could also be a flag. Sorry. We might skip the poll at this time, Pippa, because I'm just conscious of time.
Yep, no worries.
But
That's
certainly
fine.
if anyone wants to ask me a question in the chat, fire it away and I will try and address it. Okay, one of the final ones I wanted to talk to you about was key person risk. So this is really important, particularly if you are in a business where you're a sole trader or where you do conduct a lot of the operations. So really here we're thinking about what would happen if you were incapacitated. So you couldn't participate in your business. Maybe you couldn't manage it, you couldn't run it, you couldn't operate, you couldn't do any of the day-to-day tasks. How would you actually manage the business through that period and try and have it still able to be there for when you are able to return to work? So a couple of things here to consider is that you might bring a casual type employee in, even though they might not be necessarily totally required. You might use them as an additional labour resource that can then cover a period of time where you are out of action. So that's something that I know some businesses have considered doing, just because that risk is quite significant to them. And secondly, you can look at things like key person risk. And so what you're really trying to do there is insure yourself so that if you were incapacitated, you'd have the financial resources to make any changes in the business that you needed to. So that might involve getting in full-time staff member, or it might involve using contractors for all the operations. Now that will be at a financial cost to your business, and you would also still have to obviously draw some living wages while that's occurring. And so then you look at implementing an insurance that would cover those financial costs, and you can, look at a time over which you think that might be relevant. So it may, for instance, be, if I wasn't able to work for 12 months, what would be the costs to my business to be able to still run it and operate it using either full-time labour or contractors? And then you have an insurance in place that would pay out an amount of money that would help you meet those costs. So it's probably all I wanted to really talk about there. The key person might be you, but it might actually be someone else. But it's just about having a plan as to how you'd manage if that person couldn't be active in the business. Now, this is one that banks really do focus on because they understand the importance of operators or owners in a business. Again, I might just skip the poll because I know I'm getting quite tight for time here, and I really do want to cover on compliance risk as the last part of our session together tonight. So compliance risk, this is an organisation's potential exposure to legal penalties, financial forfeiture and material loss resulting from its failure to act in accordance with industry laws and regulations, internal policies or prescribed best practices. So I do want to highlight this as an area, but I don't want to cause anyone any sense of panic because this is all quite manageable. Okay, so let's move on. So compliance risk, there's a few different areas when it comes to our agricultural type businesses. So if we've got animals involved, we obviously have to manage their welfare at a prescribed level. And certainly we don't just do that because it is by law. We know over and over again that animals that have good welfare actually thrive and do a lot better. So it makes just total sense on every level. So if you have animals, the Prevention of Cruelty to Animals Act is the one that covers this area, and that is administered by Agriculture Victoria. So not necessarily that they're out enforcing it, but certainly, excuse me, I know there was some, the Victorian government, I think, flagged a review of this area. And so Agriculture Victoria last year put out a submission for any feedback or submissions to inform the review of this area. If you have employees, their occupational health and safety requirements that you would have to meet, and they're defined under the Occupational Health and Safety Act 2004, and they're administered by WorkSafe Victoria. So WorkSafe Victoria, I'll give you some resources in a moment, but they do have a good website that's got a lot of tools. It's got a lot of information to help businesses comply in this area. And now one of the key takeouts here is that really if you have employees, and I shouldn't just say employees, this applies to yourself, your family members, if you work on farm or in a farming business, it just makes really good sense to be managing any of those OH&S risks and trying to eliminate them from your business, or, you know, as much as possible. If you are involved in transporting of livestock and goods, there's the Road Safety Act administered by Vic Roads. So there it's around load lengths, total weight of loads. There's some specifications that you'd need to be across in that respect. So here I'm just trying to highlight out the broad categories so that you know that you may have obligations, and then I will also give you some resources to refer to. Again, if you have employees, around pay and remuneration, there's some definite compliance that you need to meet here. So there's a couple of different awards. All of this is covered by the Fair Work Ombudsman. So they're the ones that basically administrate and enforce these issues, and they do look for breaches. So most of agriculture employees are covered under the Pastoral Award. Horticulture has its own award, and then sort of surprised me, there's also another award that applies called the Cotton Ginning Award. But there are a number of different awards for industry, but your first port of call if you're in agriculture other than horticulture is pastoral, and obviously horticulture has its own award that basically specifies pay and conditions of employment that need to be met. And there's also certain obligations that you need to comply with if you are employing someone in your business. Further to that, things like the use of pesticides and veterinary medicines, there's compliance around the use of those products. The APVM sets those guidelines, so just be aware that they exist and comply with those where practicable, and basically, particularly with chemicals, there can be some significant detrimental impacts where we don't comply there. And Agriculture Victoria actually has oversight over a number of the different acts there, which I've detailed. So that's the compliance aspect. So, okay, if any of that started to concern you, please allay your fears. There's a very good website, People in Agriculture, that will cover across a number of things around compliance with pay, remuneration, and employing people. If you needed any further information on some of the legislations, Agriculture Victoria might be a first port of call. And if you have issues around OH&S, there is a very good website put out by WorkSafe Victoria, and it's the link is there, and it has great tools and ways to get you started. And if you're in doubt, there are people in these spaces that would help your business basically set up some basic systems and processes that would help you to ensure that you are compliant. Okay, so sorry, I've not left us a heap of time, Sarah, to do the closeout poll with everyone online tonight to see how they found today's session, but I might hand back to you for that.
Thanks, Jane. Fantastic presentation. I know I've been muted here, but it's been great to hear all those risks and how to manage them. So thanks so much for that. So
No
Pippa,
I've launched the evaluation poll, so it is up there, and I think most of the people with us tonight have come to at least one of the other sessions, so they will by now be familiar with the process. So if you just, we've got results coming in already, so that's great. If you have time to fill that out for us tonight, we really appreciate it.
Excellent. And again, I just encourage everyone, I did obviously focus quite a bit on some of those risks that can impact businesses, in a maybe negative way, but please be reassured that there is also some very good opportunity in businesses to achieve more than we expected. So please, balance out that thought process. There are some things that we do need to be aware of and that we do need to manage, But really there's great opportunities still with farming business. And I appreciate you all filling out the poll at the end of the webinar.
Yeah, I can see everyone's taken the time to fill that one out tonight. So that's great, guys. Thank you so much.
It's really appreciated. It's great feedback for me, and it certainly would help us developing, you know, on further sessions from here. With your feedback, we can refine things. So thanks to everyone.